Welcome everyone to our 6th series of the video tutorials. In this series, we will be covering the use of technical analysis for trading. We will discuss the basic tools of technical analysis, such as the trend lines, support and resistance, chart patterns, and formations. In this first tutorial, we will begin with the most basic tool of technical analysis, that is the support and resistance levels. Before that, we begin with a brief introduction to technical analysis. Trading techniques are broadly classified into two styles. One is the fundamental analysis, where analysts study and research the overall economic and financial conditions to evaluate or forecast the likely future price movements. Technical analysis, on the other hand, uses statistics and market data to forecast the direction of price movement of a financial instrument. It uses past price data to evaluate the future price movement, since it is based on the principle that historical performance is indicative of the future movement. In this technique, the past price data is examined using technical tools such as the chart patterns, indicators for forecasting. It considers the current price of a financial instrument to fully reflect all the information about it. So let's start with understanding how the most basic tools of technical analysis, that is the support and resistance levels, are used in trading. Support is the price level from where the price of a financial instrument has a strong likelihood of bouncing back up towards higher price values. It is formed when the price of an instrument hovers around a certain level for a considerable time, attempting to break below it. It is the technical level the financial instrument tries to break below but fails to do so. Moving on to the resistance. Resistance is the price level from where the price of a financial instrument has a strong likelihood of sliding back down towards lower price values. Just like the support, the resistance is formed at a certain level when the price of an instrument hovers around that certain level for a considerable time, attempting to break above it. It is the technical level which the instrument tries to break above but fails to do so. Now that we understand what the support and resistance levels are, we will now try to understand how to use them while trading. For a price that acts as a support level, if the current price of the financial instrument is well above that underlying support level, however, is sliding down to lower levels, it is likely that the price will slide down up to the underlying support level. When the current market price reaches close to that support level, it is considered as a buying opportunity. Traders look to buy the underlying instrument as close to the support level as possible. If, however, the price breaks the support level and falls below it considerably, the price no longer acts as a support. In this case, when the price falls considerably below a support level, that level then becomes the overhead resistance. Similarly is the case for a price level that acts as the overhead resistance. If the current price of the financial instrument being traded is well below the overhead resistance level, however, is trending up towards higher price levels, then it is likely that the price will trend up to that overhead resistance. When the current market price reaches close to the resistance level, it is considered as a selling opportunity. Traders look to sell the underlying instrument as close to the resistance level as possible. If, however, the price of the financial instrument breaks above this resistance level and trends above it considerably, the price then no longer acts as a resistance. In this case, once the price rises considerably above the resistance level, that level then becomes the underlying support. Let's have a look on the trading platform to see how this works. Let's consider the 4-hour chart for the Aussie dollar. As you can see, this level is acting as the overhead resistance. Now when the price of the Aussie dollar was trading between these two lines, let's say at this point, then this level would be the overhead resistance and the level below would act as the underlying support. As you can see, once the price broke below the support level, the support then becomes the new overhead resistance as the price trends lower. So now, at the current price level, this level, which was initially an underlying support, is now acting as the overhead resistance. Similarly, if you look over here, the price of the Aussie dollar is seen to be making multiple tops at the level around 0.92942. This level is behaving as the overhead resistance. The price tried to break below the 91,374 level over here number of times. Therefore, this level is acting as the underlying support. Now, if you examine this area, once the price reached close to the overhead resistance, it was unable to break above it and took resistance over here. So one should consider selling the instrument or the currency pair, that is the Aussie dollar, close to these levels and try to buy them back or close their position close to the underlying support level. As you can see, at this point, the price of the Aussie dollar came close to the underlying support level and broke below it. Therefore, now this level no longer will act as the underlying support and the price will continue to trend downwards. This underlying support now becomes the overhead resistance. As you can see, once the price made the low and started retracing back, the previous underlying support is now acting as the overhead resistance. Once the price broke above this level, it trended up towards higher levels. The next overhead resistance would stand at previous 0.9294. However, the price could not trend up to those levels and trended back down below this level back again. So this way, we can use support and resistance levels for trade signals to initiate or close our trade positions. Well, this is all that we will be covering in this video about support and resistance levels. Thank you for taking the time to watch this video.